Hi everyone. Welcome back to my YouTube channel MANUISHU ACCA classes. So in today's video, we will do one long question and this is from the F3 paper. This is for the F3 paper and the question name is Post and Solve. So previously I have uploaded 80% of this kit, and in case you want to watch it out, you can access it from the playlist available on my YouTube channel at free of cost. There is no any payment that you need to be made in order to watch the video. It's free of cost. And one more thing, in case you have any doubt, you can come to me anytime. I will really address your query in giving the priority, right? Okay, so let's start the today question, and the question name is Post and Solve. So if you look at the question, they have provided the profit and loss, and I will highlight the few things that you need to look in the question, and then why we need to look for that information. I will also explain that. So please stay tuned with this video till end. All right. So here they have provided the profit and loss, and the year end is 30 September 20x8, and this is very important to know the year end. And why so? Because if the company has been acquired at the mid of the year, in that case, while preparing the consolidated profit and loss, we need to proportionate each income and expense. So that's why we need to look at the date of acquisition along with the year end, so that we can know whether it's mid-year case or not. So they have provided the profit and loss and financial position as well, and there are few note they have provided, but let's look to the requirement before reading that note. So first one is asking, state the accounting entries required to account for the issue of shares by post upon acquisition of so now let's figure out what the what the journal entry will be when push is acquiring so we got to know that push is a parent and who is acquiring the subsidiary name okay. So while doing consolidated question, I have told multiple of time in my previous video that you need to do 5 working, and why so? It's not compulsory to do 5 working, but you should be familiar with the 5 working, because the question asked will be from this 5 working. Okay, so let's I have made a group structure so that I could know whether there is any NCI or not, and I hope I must say you guys know what the NCI is. So when the parent acquired less than 100% of shares, in that case the other remaining shares, like in our case parent who is the push, who acquires 60% of the share of the right? So that means 40% of the shares is acquired by other one. So it's known as non-controlling interest. Okay, so that's why I have made a group structure like this, and what the question says, it has been acquired on the 1st October 20x7, and this is very important, that's why I have written here. So on 1st October 20x7, post acquired show. Okay, so now we year end is our 30 September 20x8. So that means it's 1 year acquisition. There is no mid-year acquisition case. Alright. Okay. Now what we need to look here is because question is asking because push has the issue some shares and what will be the journal entry. So here we need to look for the what is the consideration. So here if we read this sentence that the push acquired 60% of equity share capital of the in a share exchange of 5 shares in the push for 6 shares in the the issue of share has not been recorded by push at the date of the acquisition. Shares in the push has a fair value of $6 each. See, so here is the shares for share exchange, means I will give you my few share and you will give my few share. So here is the deal is like for the share to share exchange, and how many shares a push has been given for the acquiring the soft share. So push have exchanged 5 shares. Push has given 5 shares in order to acquire the 6 shares in the but as this issue has not been accounted, that's why the question is asking what will be the journal entry to record this transaction. Okay, Now the transaction is share for share exchange, no doubt. But before moving into how many shares that push acquired, we will do a simple calculation step by step. Just be with me and focus. Okay. So push acquired 60% of equity share. Now the first question is how much equity share capital of the SOV is. So from where we can get this information? Obviously from the statement of financial position. And whom? Of SOV, not for the push, right? Okay, so if you look at the statement of financial position of the SOV, and there is 4,000, and this is not the 4,000, it's a 4 million. And why they have written the 4,000? Because they have taken the 30 as common. So this is also the mistake point where a student did the mistake. Suppose if the question has provided the blank, there is no format, in that case you have to write in the million. But if question says to take a 30 common, in that case it will not be problem. So you need to check it out, the format, and whether they have taken 30 or not in a common. Okay, now we need to find out the number of shares of SOV, right? So share capital value is 4,000. So and each share nominal value is 1. So this is also the things that student did the mistake. Sometimes they blindly assume that nominal value or the fair value of each share will be 1, but in some cases it will not be the same. There might be 1.5, 2. So please look at least one time what is the fair value. Okay, so that means number of shares in the SOV is 4,000, and its share cost, fair value is 1, so it will give the 4,000 as a share capital value. So this number of share is 4 million, and as they have taken 4,000, because they taken 30 common, that's why they have written the 4,000. So how many shares the push has acquired? 60%, and 60% of 4 million share. So this means this will be your just a second. So we will do a few calculation, like 60%, right? 60% into 4 million. So that means 2.4 million share has been acquired by SOV. Okay, so now, but share has been acquired, but the push also have exchanged their own shares, right? We need to calculate that as well. So what we will do here, I have written that the push gives 6 shares in return as well, in order to acquire the 5 share in the push for 6 share in the SOV. Okay, sorry, push give 5 shares, not 6, 5. Okay. Okay, so now what we will do, so how can we calculate how much share has been given by the push in order to acquire the share? So here again we will take 60% of the 4 million, but we will multiply this time 5 into 6, because this is the number of share of the SOV, and for every 6 year we have given 5. So you can perform this calculation like something like this, like this is the number of share for the SOV, right? And for every 6 year 5 has been given, so we need to calculate the batch of 6. So how many batch will be for the 6? It is 0.4, and now the 5 share has been provided by the push, so we need to multiply by 5, so that means 2 million shares. Okay, now the fair value given for the share is for the push, not for the SOV. So here the fair value of push share will be 2 into 6. That means 12 million. So this is the things I have done here. So value of push share which they have exchanged is the 12 million. And but if we talk about the value of SOV shares, means value of acquisition, so we will not multiply it by 6, because it is not the fair value of SOV. So now we will read further and we will figure out that figure as well. So at date of acquisition, fair value of SOV net assets were approximately equal to the carrying amount. So means that there is no any change in the fair value, because while doing consolidation, we need to record every asset at the fair value. But the question says that there has no change in the net asset value. So that means we don't need to take a headache for the revaluation fair value adjustment. That's all. Suppose has a policy of accounting for NCI at a fair value, and the fair value of one shares in the put at the date of acquisition was 3.50. So this is the fair value of soft shares, and we will multiply here. Okay. So we will multiply here by 3.5. So that means 60% into 4 into 5 by 6 into 3.5, which I have done here. So this is the value of shares. All right. So now the question asks to pass the journal entry in order to record this transaction. Right. So how we will do this entry? Let's come to the question again. So do you think this entry will hit the revaluation surplus? No. So we will do nothing for the revaluation surplus. Now issue of share capital. Has the share has been issued by the push? Yes. And what is the share capital value? So we need to figure out that. So that means 2 million share has been issued. Okay, and that means nominal value of the push share is as well $1 for the each. So 2 million into 1, it will be 2. So here we will write down the 2, but not 2. Why? Because they have taken the 30 in the common. So as I said, this is a mistake point where we do the mistake. So here we will write 2000. Okay, so we will write 2000. And what do you think? It will be on the debit side or the credit side? Obviously, share capital is recorded on the credit side. Okay. Okay, so investment in the swaps. Do you think this will hit? I mean, this account will be hit due to this transaction. Yes. And what is the value of investment in the swap? It's a fair value consideration. So that means fair value in the consideration is 12 million. Yeah. The push share value is 12 million. So we will write down here 12, but 12,000, I mean. Yeah, 12,000 here we will write down, but as it is an investment, that is it is an asset, so we will record it on the debit side. All right, so we will write here debit. Okay, so now do you think return earning will be hit by this transaction? No, again we will do nothing for the return earning, but yes, for share premium it will again hit. Why? Because the value of share is 6 million and the nominal value is 1, so difference is a share premium. So what is the difference? That is 5, and how many shares has been issued? 2 million, so that means 10,000, and again it will be on the credit side. I hope you have understood this question. It will be again on the credit side. Okay, so look at this. This is the journal entry. So fair value of push consideration. Sorry, this is for the question 1. So this one is, yeah. So investment, as we are doing investment in the other company, right? So see, if we are preparing the consolidated statement, in that case this part will not come. Okay, because we are preparing consolidated statement, so that's why this part will not come. But in the individual entities financial account, like for the push, this will be recorded as the investment in the SOAP. So that's why investment in the SOAP will be debit side, and as 2 million share has been issued by the push in order to acquire the shares in the SOAP. So and fair value nominal value of those share is 1, so 2 million, so 2 here, and fair value was 6, so difference is 5, so 5 is the premium. 5 into 2 means 10. So this is in the million, but the question has taken the 30 in the common. That's why we have written down 2,000, 12,000, 10,000. So I hope this is clear now. Now the second part asks to calculate the goodwill on the acquisition of the soap. So what is the goodwill? First, do you know about this? So basically, goodwill is the excess amount. I mean, suppose the value of net asset is 10,000, but we are paying 12,000. So difference is the goodwill. So you are paying for the goodwill. Okay, and how we do the calculation for the goodwill? We will take the fair value of the consideration that we have paid and the fair value of NCI, and then we will deduct the fair value of net asset, and the remaining will be the goodwill. Okay, so goodwill calculation is the third step. As I said in the start of the video, there is 5 working that you should be familiar. So goodwill calculation is the third one. Second working is for the net asset. Okay, so now the fair value of the push in the consideration we have already calculated is 12,000, and the fair value of NCA that we need to calculate. And how can we calculate? So first we need to calculate the number of shares. Number of shares in the push so was 4,000 if we look at the question, right? So 4,000 as 30 has taken the common, and 60% is acquired by the push. That means 40% will be acquired by SOAP, and the fair value of the SOAP share is 3.5. You can look here that. So 3.5, this will give the 5,600. All right. So I have written here 5,600. And fair value of net asset at acquisition, we need to calculate this again, because as I said, this is a step 2. So we need to calculate this again. And how can we calculate? Yeah, here it is. So we will take net asset at acquisition and net asset at reporting for the calculation, but here we only need the net asset value at the acquisition. So what we will take? First we will take the share capital and the share premium. But if we look at the share capital and the share premium, there is only share capital in the SOAP account. We will need to take this value from the SOAP account, not from the push account. So we will take the 4,000, and again we will take the retained earning value. So retained earning value is your 16,500. But the trick is here. Just let me copy paste this here so I can explain in the easy way. Okay. So 16,500. All right. Retained earning value is 16,500. See, for the net asset calculation, we will take the every item of the equity, plus if there is a revaluation surplus, fair value adjustment, we need to also consider that part in the net asset calculation. Right. I think for the FA it will not be much more complex, but for the FR and SPR it will be. All right. So we will take this equity portion, and as I have taken the share capital and the retained earning, but here trick where the student did the mistake is, see, the retained earning is for the year in 30 September 20 exit. So that means this 16,500 is for the reporting date, not for the date of acquisition. So you might be thinking, so what will be the value of retained earning at the date of acquisition? So here above they have provided the PLI term. So that means this profit has been added during the year in this retained earning. So that part we need to deduct. So that's why I have here deducted the 4,100 from the 16,500, which will give the value of 12,400. So at the date of acquisition, date of reporting date, the retained earning value will be 16,500. But at the acquisition, we need to deduct the profit that the SOAP has earned during the year. Yeah, because the acquisition date is your 1st October. Right. So that's why I have made adjustment in this retained earning part. So now we can get the total value at the net asset at acquisition by adding these two. And I have kept it here as 16,400, and this will give us the goodwill of 1,200. Now we have performed our calculation. We need to fill the box. So what the first box is saying, look for the item 1, the fair value of consideration paid. So in item 1, select the formula which correctly calculate the fair value of consideration paid. So how do we calculate the 12,000? How do we calculate? B17. Yeah, this is the case. So we have taken 60% of 4 million. So as they have taken the 30 in the common, that means 60% of the 4,000. So in every option you will find this. Okay, but here we need to adjust that the share exchange portion. So we have multiplied by 5 into 6 as well in the option 2 and 3. So option 1 is omitted because they have not multiplied 5 by 6. So option 2 and 3 is there is a multiplication of 5 by 6 to the value in the option 2 and 3. Now the question comes for the fair value. So what is the fair value of the push? It's 6 million. per share. So that's why we will multiply it by 6, and so that means this option is correct. Okay. Okay, so now fair value of NCI at acquisition. So you need to write the value here directly because there is no any item noted down here. So that is the 5600 which we have calculated. Now the fair value of net asset at acquisition, again for the share capital you need to put the value directly, that is the 4000. But for the return earning they have provided the item 2. So in item 2 what they have told, select the formula which correctly calculate the return earning of the shop at the date of acquisition. So 16,500 is not correct. Why? Because it is the return earning at the reporting date. So next one is 16,500 minus 4,100. Yes, this is one is the correct calculation of return earning at acquisition date. And last is 35,400 minus 4,100. So 35,400 is return earning of parent, not for the shop. So here we will only take for the shop, not for the parents. So that's why it's incorrect. So our correct option is second one. Okay. Okay, so now third item, that is the, yeah, select the which of the following calculates the goodwill, correctly calculates the goodwill. Fair value of consideration, yes, we have taken the fair value of consideration, plus fair value of NCI controlling interest at acquisition date. Yes, we have taken the fair value of NCI, plus fair value of net asset at acquisition. No, we will don't do plus, we will subtract. So that's why it's incorrect. Fair value of consideration paid minus fair value of NCI. So it won't be minus, it will be plus, because we will add the fair value of both for the parent and the NCI, and then we will subtract the net asset. So it's also incorrect. Fair value of consideration paid plus fair value of NCI at acquisition date minus fair value of net asset at acquisition. Yes, this one is the correct, which explain the correctly how to calculate the goodwill. So this is for the task 1. Let's move to the task 2. Calculate the which of the following figure for inclusion in the consolidated statement of financial position. See, you need to check it out whether the question is asking for the individual entity or for the consolidation. So here the question is asking for the consolidation. So what will be the non-current asset value? So non-current asset for the both entity is 4,600 and 22,600, and you need to check it out whether there is difference in the fair value of this asset due to revaluation. But in the question says there has been no change in the fair value from the acquisition, so that's why we don't need to worry about that part. So adding these two will give the value of NCI, which will be your let's add together. Where is my calculator? Yes, so here it will be what is the amount? Yes, it is 4,600 plus 22,600. So 63,200. All right, so we will write down here 63,200. And they have taken 30 common. Please make sure to check it out this. Now for the current asset. Okay. See, in the consolidated statement of financial position, we add item line by line, and but few things, few adjustments need to be done as well. Like as I said, for the non-current asset, we will do the adjustment for the revaluation one, and for the current asset, again we will add this to 16,000 plus 6,600. But here we need to check it out whether there has been intra-group trading between these two company or not. And why so? Because we need to make adjustment for the POP. So selling between intra-trading between these two company means we are just transferring one profit in from one hand to other hand. So it has not been sold out. If the goods sold between these two party has been sold to the customer outside the organization, in that case there will be no adjustment for the POP. So but if the goods has not been sold it out, in that case we need to do adjustment for the POP. So we need to check it out whether there is intra-group trading between the company or not. Okay, so and a question also mentioned that goodwill has not been impaired at 30 September 20 exit. So sales by soap to push. Yeah, So there is intra-trading company between the company. So sales by soap to push during the year in 30 September 20X were 6 million. So total value of the goods sold is 6 million. So made a markup on the cost of 20% on this sale. See, there is difference between the markup and the margin. So markup is basically on the cost, where the cost will be 100%, and if we add the markup of 20%, so it will be the 120. But margin is on the sale, that means sales value will be 100, and adding the margin of 20% make the sales values 120. Okay. Okay, so 1/4 of these goods remain in the inventory of the post at the year end. Means all goods has not been sold outside the organization. There is still 1/4 of these goods remaining in the inventory. So that means there will be adjustment for the perf as well. So see, if the subsidiary sold goods to the parent, I think this will not be the case in our question, but please remember, if the subsidiary sold goods to the parent, in that case, adjustment of the POP should be made from the working to, that is the net asset calculation. But if parent sold the goods to the subsidiary and the goods has not been sold it outside the organization, in that case, POP adjustment will be made from the working file, that is the group retained earning. All right, I hope up to this it is clear now. Okay, so now goods has been sold by soap to push. Okay, so that's why arrow has been in the opposite side. So now value of goods is 6 million and goods remain in the inventory is 1/4. So I have divided this by 4. This give us 1.5 million. So now we need to calculate the POP. So POP is for the markup cost on 20%. So as I said, there is difference between the markup and the margin. So I will explain one more time. So if the question said markup, okay, so in that case your cost value will be 100%, and markup, adding markup of 20% will give you the selling price, which will be 120%. Okay, but if it margin has been given, like if in same situation margin has been given, yeah, so if margin has been given a margin, in that case, so in that case, your cost will be no more 100%, it will be 80%, and your selling price will be 100%. So there is difference between these two calculations. Please make sure whether question is asking, question has provided the markup or the margin, because the treatment will be different. But in our case, the markup has been provided, so I will omit this part. And for the markup, how we will calculate the margin? So the value of goods was 6 million, out of which 1/4 million goods is remaining in the inventory. So this is the selling price, right? So this is the selling price. That means this is the value that we sold out to the customer. Okay, so 20% of this value will be, now selling price is 6 million. Now if we talk about the cost, it will be your, the remaining goods in the inventory is 1.5, and we need to calculate the cost. That means this is the 120%, and we need to multiply with 100. Why? Because we need to calculate the value of cost. So that means if you want to calculate the value of cost, you need to take the selling price, multiply it by 100, divide by 120. If the percentage is 20% in that case. So now the cost is 1.25. So now the 20% of the same will be your 0.25 million. Okay, so this will be your POP is 0.25 million. All right, so and otherwise you can calculate it directly as well, POP, rather than calculating the cost. What you can do is you can take the selling price, and selling price is your 120%, so we will divide by 120%. Now instead of multiplying with 100, we will directly multiply with 20, which will give the margin, markup of 20%, which is 0.25 million. I hope this is clear now. Okay, so from the current asset, we need to deduct this POP. So as they have taken the 30 in the common, so multiplying this with the 1000 will give us 250. Okay, so here current asset, for the current asset calculation, so now value of current asset is your 16,000 plus 6600, and now 16,000 plus 6600, we need to make adjustment for the POP, which is 250. Okay, we have done the calculation here. So now one more thing, we need to check it out whether there is receivable payables remaining in the any of the account of the company. So in the last note, what they told, at September 20x8, SOV had a receivable due from the push of 1 million, and this agreed with the amount payable to SOV in the push financial statement. So means in the push financial statement, it has been recorded as the payable, but in the SOV financial statement, it has been recorded as the receivable. So that means receivable is also part of the current asset. So we need to deduct this amount as well, because as I said, we will not keep any intra-company transaction in our consolidated statement of financial statement. I mean, so that's why we need to make adjustment for this as well. So we will minus thousand, do minus thousand. Why? Because we are taking the 30 as a common. So now doing all this calculation will give us value of your 250 minus 1,000. Yes, 21350. Okay, so we have taken 30 common, and question also required to take the 30 common. So a value will be 21350. Okay, so now current liability. So if we look for the current liability, okay, so now if we look for the current liability, the current liability in the both case is 8200 plus 4700. But if we have deducted receivable from the SOW, we need to deduct the payable from the push as well. So we will add this to amount 8200 plus 4700 and subtract 1000. Okay, so we need to check it out whether there is any receivable or payable balance or not, whether there is any goods being sold between the company or not. So we need to check it out for this kind of calculation. So we are done with the task 2 as well. Now let's move to the task 3. What the question is asking, select which of the following, correctly calculate each of the following item for inclusion in the consolidated financial position. So non-controlling interest at reporting date. So while calculation of the goodwill, how we have calculated the value of NCI? Yeah, here it is. So we have taken 60. We have taken the 4,000 shares, right, of the SO, and as the spoos acquired 60%, that means remaining 40% is acquired by the your NCI. And what is the fair value of SOV asset? It was 3.5, if you remember those paragraph. So this will be the calculation part for the NCI. Okay. So now this is just the fair value, right? So question is asking for the working for the calculation of NCI. So NCI value, for calculation of NCI value, so first we need to find out the fair value of NCI at reporting date, and we have found that it's 5600, and we need to add the increase in net asset value, I mean post acquisition value. 40% of NCI value, we need to add it here. So we need to find out what is the net asset value. So yeah, here it is. So total net asset at acquisition was your this one. and net asset at reporting date was 20,500, and difference is the post increase in the value, post acquisition increase in the value of net asset, which is the 4,100. And we will take this for again one more thing. As the asset has been goods has been sold by soap to the push. If you look at the question, the goods has been sold by soap to push, and I have said that if the subsidiary is selling goods to the parent, in that case we will adjust the POR from the working too. So we need to make addition for the POP here as well, and we will subtract 250 amount from here. So this will give the total value of, okay, so now 38,500. So we need to add this 40% of post acquisition net assets. So it will be your 40% into this amount, because this net asset change in movement in the net asset need to be apportioned between the parent and the NCI. So we will only take NCI portion in the NCI value calculation. So now the question is not asking the final value, they're asking just to select the which will be the correct option. So if we have calculated the fair value, so it is very easy to figure out which option is correct, because for the calculation of fair value of NCI, we have taken 40% of the 4,000 and multiplied by the fair value of shares, its share of soap, which is 3.5. And there is only one option here where the 3.5 has been multiplied with the number of shares, right? So this one is correct. And this one is also correct, because if we don't consider the POP, the change in the net asset value is 4,100. And but if we will consider the POP, that means subtract 250. So this will, the value will be 38,500. So what they have done, they have taken the NCI percentage, which is 40%, and multiply by the 4,100 minus 250. So that's why this option is correct. Now, retained earning at the reporting day. So this is for the working 5. So working 5, we calculate group retained earning. So that's why I have said that you must be familiar with the 5 working. The first one is the calculation of the group structure, the consideration paid. Second one is the net asset calculation. Third one is your goodwill calculation. Fourth one is NCI calculation. And last one is retained earning. And the question has tested every part here. Okay, for the group retained earning, we will take the parent's first retained earning, and in our case, parent retained earning is 35,400. Okay, and again we will take post acquisition increase in the value of asset, post asset acquisition percentage. So it's 60% into this value, or what you can do is 60% into 4,100 minus 250. Okay, now if the parent has been sold the goods to the soap, in that case POR, we will adjust this POR from this calculation, not here. But in our case, subsidiary has sold goods to the parent, that's why we will not adjust the POP here. So adding these two will give us the profit of 37,700. But the question is asking to select the cell for calculation of the value. So we have taken 35,500. So these two have only the figure 35,500. That's why option 2 has been eliminated. And for the net asset, we will take 60% into 38,500. And how 38,500 has been arrived? 4,100 minus 250. So there is only one option. There's two option again, but the second one is already been eliminated. And from 1 and 3, 3 have only the option where they have subtracted 4,100 minus 250, then taken 60% of the value. So this one is the correct here. Now for tax, select which of the following, correctly calculate each of the following item inclusion in the consolidated statement of profit or loss. So again, for the profit or loss, For which figure they have been asked? For revenue. Okay, fine. For the revenue, yeah, this is the P&L for the both of the company. So in case of consolidated statement of profit or loss, we will again add item line by line, but we need to check it out whether there is mid-year case or not, because in case of mid-year acquisition, we need to proportionate this value, but in our case, it's not a mid-year acquisition. So we need to add line by line, but again, few things that you need to consider, especially in the FA, regarding the POP and the goods sold adjustment. So here, so revenue will be no doubt 85,000 plus 42,000, but there should be adjustment for the intra-group transaction, which is of 6 million. Yeah, so they have sold the goods. So one company might have recorded the cost of sales and other might have recorded as the revenue, because one company have been purchased, other company has been sold it out, right? So we need to remove this amount from the both COS and the revenue. So if we look at the option, so 85,000, 42,000 and minus 6,000. Yes. So this will be the case and this one is the correct option. Why so? So we already know that we will add these two, and there are only two options where this two value has been added. So option second has been eliminated. Okay, and we need to subtract for the intra-group transactions. So they are adding this 6,000 in the option 3, so that's why it has also been eliminated. So only option first one is correct. For the cost of sales, again the same case. So for the cost of sales, we need to do two adjustment. So first, let's find out what is the value of cost of sales in the both of the entity, 63,000 and 32,000. All right, 63,000 and 32,000. So there are only two options where this two value has been added. So option 3 has been eliminated. So now in the cost of sales, we need to do two adjustment. One is for the intra-group transaction regarding the sales and purchase, and other is for the POP. Okay, so we will subtract again 6,000 here, and regarding the POP, we will not subtract. Why so? Because this will be added. And why so? Because in COS, closing inventory is being deducted, right? So, and this POF will form the part of the closing inventory. So if we will minus this POF from the closing inventory and opening the bracket like something like this, suppose our closing inventory value is your X, suppose, and we need to make adjustment this for this POP, which is 250. So we will subtract 250 here. So this will give my closing inventory value of X minus 250, right? So now in the COS, cost of sales, what is the formula? Your opening inventory plus purchase minus closing inventory, right? So opening inventory plus purchase minus closing. Instead of closing inventory, we will write on the value of X minus 250. Okay. Okay. Now, if we will open the bracket now, so if we will open the bracket, so it will be minus X, but minus, it will give this plus, so it will be plus 250. So that's why we are adding 250 here, not subtracting. So second option seems to be correct. So we are done this with this question. So I hope you have found this video useful. In case you have found this useful, please share it among your friends and don't forget to subscribe my channel for more updates like this. Thank you so much. Have a good day.